Hey everyone, welcome back to All Things Home Loans, Credit, and Real Estate. I am your host, Deb, the Mortgage Queen. So let's start learning.
All right, so you want to buy an investment property, but you are super good with your income taxes and you show no income. Don't pay taxes, don't show income. Most of the time you don't qualify for a mortgage loan. There is a program as an investor that we can use. It's called the DSCR program that uses only the income off the property. Let's walk down the path. DSCR stands for Debt Service Coverage Ratio. Basically, is my debt being covered by somebody else making the payment? There's 4 different levels that we can go in at. It's a 1-0 or a 0-1 ratio. I actually screwed that up on the paper, so congratulations. A 0.5-1 ratio, a 1-1 ratio, and a 1.25-1 ratio. And I want to explain that. And what we're going to use in our example is a $2,500 all-in payment. Principal, interest, tax, insurance, and if there's an HOA, it all has to be included in there when we're trying to calculate our debt service coverage. Here's how it all works. If we are a 0-1 ratio, which on a side note, you have to be an investor of properties, a property management person for some time to be able to qualify for the 0-1. You got to be, or the 1-0. You've got to be able to show that you have a knowledge of managing properties, but neither here nor there. We basically don't care what the lease is. You just qualify. We know it's going to be leased. We know you're not going to occupy it. We know it's a rental property. 100% we know that. It's not even a question. We take a rate hit and a bigger down payment requirement if you do a 0-1 ratio. We don't care. We're not watching what the income is that's coming off that property. You definitely get a little bit of a penalty for that. The most popular one is the 1-1, but let's break it down. A better situation is 0.5-1, which works out this way. Half of our $2,500 is covered by the rent. So I'm only receiving $1,250 in rent of my $2,500 payment. 0.5-1 ratio. 0.5-1 ratio. There is an interest rate increase on that because of the ratio that's here. So we definitely want to have a closer to 1-1 number. 1-1 meaning I'm receiving $2,500 in rental income. I have a $2,500 house payment. 1-1. Get that? Here's where it gets fun. If you end up getting a killer deal, and I'm telling you, there are killer deals out there. I just financed a property that is going to cash flow, and it's a multifamily, and it's cash flowing pretty dang good. And I'm really proud of the gentleman who was able to purchase it because it's cash flowing right from the get-go, and it's awesome. It's awesome. Anyways, the 1.25-1 ratio actually helps us with our interest rate because it's saying, hey guy, you're receiving $31.25 per month, basically 1.25 of 2,500. You're receiving this and you're paying this. There's actually a positive number there. When we're looking at the debt service coverage ratio program, there's reserve requirements. So you have to have money in the bank. And there's 2 reasons why we want to have money in the bank. First of all, you do have vacancy. You're going to have somebody move in. You're going to have somebody move out. You're going to have a window of time that maybe there's some repairs that need to be done. And so you don't have rental income coming in. You have to be able to have reserves in your bank account to make payments when somebody is not renting the property. You also have to have money in your bank account to be able to pay for those repairs. You have to be able to have money in your bank account if somebody is just a schmuck of a tenant and don't pay their rent payment, and you're having to struggle being able to make your mortgage payment because you're relying on the rent payment. You have to have reserves. You've got to have money that you can fall back on to be able to take care of those months for no rental income coming in. It also shows that you are fiscally responsible. If you've got money in the bank account, that shows that you can survive with the savings account in your bank. That's a huge plus to us as an investor. We want to make sure that you are lining yourself up for success because we don't want to get you into a whole bunch of investment properties. You can't make the payments, you don't have any money to fall back on, and all of a sudden you have these foreclosures. You've damaged your credit, you've caused issues with tenants that are living in the home, you've caused issues with your household world because now you're damaging your credit, which is going to affect a lot of things down the line. But the greatest thing about this program is the fact that I don't need income taxes, I don't need W-2s or pay stubs. I need nothing when it comes to the income other than the lease agreement. The debt service coverage ratio program kind of makes you a little bit nervous. I think when it first came out, I was like, I'm not sure about this program because it took me right back into the stated income days and some of the programs that were going on that were a little bit scary, that got us into some trouble. But when it come down to it, it was, here's a legitimate lease that shows that this human is going to be making this payment towards this mortgage payment every month, towards the income of the new borrower borrowing the money. A little bit different than stated income. It's a program that allows people who are very aggressive on their income taxes with deductions to be able to take advantage of qualifying for rental properties. Just because you're self-employed and you have a lot of deductions, therefore you're not really showing enough income to qualify, makes it really hard to be able to purchase a home. This is a huge opportunity to be able to take advantage of investment property purchases. Now, in most cases, there is a 20% down payment requirement. It is what it is. The closer you get to this 0 to 1 ratio, it's a bigger down payment. There's also a higher interest rate that comes with that. When you're talking a traditional mortgage rate from 5.75 to 6.5, depending on where you fall into that, this program could be 1.5 to 2.5 points higher. Why? Well, because it's risky. We're not documenting some of this income that would really be nice to document. So therefore, there's a risk. Where there's a risk, there's a higher rate. It's just the circle of life here. It's also an opportunity you can have a prepayment penalty. If you want to get a little bit lower rate, you can put a prepayment penalty on these programs. I don't love prepayment penalties because, once again, it takes me back to my days of stated income and bank statement loans that were really bad. Prepayment penalties are fine, but we have to understand what our long-term situation is going to be. If we put a 1-year prepayment penalty on that because we want to keep this investment property for over a year, great. If we pay it off at month 6, that gives us a penalty for paying it off early. But we also have the ability to get a 5-year prepayment penalty. And when you've got a 5-year prepayment penalty, you'll see that rate go down really quite far. But it also puts you in a situation where you're going to be a big chunk of money is going to be paid out as soon as you pay that mortgage off if it's 0 to 5 years. Definitely want to outweigh what is that interest rate savings if we're going to add a prepayment penalty. Because this is considered a non-qualified mortgage, it does fall under just a little bit different rules. That's why a prepayment penalty can come into play. A standard loan, just a regular Fannie Mae, Freddie Mac, FHA, VA, those ones, they're not allowed to have prepayment penalties. That is not something that is allowed to be done. This non-QM program, they do have the ability to have those prepayment penalties to help bring the interest rate down. So as you're thinking about potentially purchasing an investment property, number one, you have to already own your primary residence. Now, I'm not saying own it outright. You can be paying a mortgage, but you can't be renting or living in mom's basement and take advantage of this DSCR program. You have to have your name tied to a primary residence as an owner. Fine paying a mortgage, but you have to be as an owner listed on a mortgage and title. Along with that, the reserves. You've got to remember, you've got to have the reserves. And then also, the more experience you have as a landlord, the better the process is, the easier the process is. Along with this DSCR loan, there is also extra paperwork when it comes to making sure that you have self-employment and that your self-employment has been open in the 2-year window of time that we would require. So it's not just start a new business in a month and buy an investment property a month from now. You still have to have that window of time that you've been self-employed. But if you're in the market to potentially look into investment properties, remember it's a long game. You can't buy an investment property in most cases and assume that you're going to start cash flowing. It's just not the reason you're doing it. You're doing it to obviously help a rental portfolio grow. So you purchase an investment property right now at the age of 30, just pay your regular mortgage payment over the next 30 years, using people's lease income to help pay that mortgage payment. At the age of 60, you've got a home that's free and clear. And think about it in this scenario. I have a home that the mortgage payment is $2,500. Great, I'm paying that. I receive income off of $2,500. Great, making the payment. Maybe I have a couple months they've moved out. Maybe I have a couple months that it's not rented because I have some repairs that have got to be done. But at the age of 60, assuming no increase on rent, my property is giving me $2,500 a month to supplement my Social Security income. I don't think that's a bad idea. I think that the thing that's a big misunderstanding is when you buy an investment property that it has to cash flow right now. I'm not saying that it does or doesn't. I'm not saying that I'm a fan of one way or the other. I'm just telling you, in real estate is a long game. You have to look at the tax benefits of owning real estate. You have to look at the tax benefits of showing a loss on real estate. So sure, maybe you're paying $100 per month just to have this rental property in your possession, but what kind of savings are you receiving on a tax return? Definitely a CPA question. I would just say that when you're looking online and you're kind of doing this brainstorming of, all right, this fair market rent is this, I think my estimated payment's going to be that, oh, I'm going to have to write a check for $200 every single month to have this rental property. Pause for just a minute, talk to your accountant and say, hey, what if I did this? What does that change to my taxes? You pencil it all out and it probably could work out on paper. Maybe it's a negative on this line item, the house, $200 a month is putting me into a negative every month on my budget. But when I file my taxes, because of how I filed my business income off of that lease, maybe I'm receiving an extra $10,000 a year in a tax break. It's a big difference there. You have the ability to make this be a negative, make this be a positive, and when it all pencils out at the bottom, you end up with a gain. Definitely worth a CPA question. But the greatest thing to remember is if you are looking at being an investor and want to start into the rental portfolio, let's get your primary residence done first if you haven't done that. But if you already own a primary residence, let's figure out how we can leverage that for your 20% down payment and start getting you into rental properties so that you can build financial wealth, which is generational wealth, which is legacies are left behind with people who have real estate and that they leave to their heirs. It's an incredible program. Definitely lined up for it to be a successful program. And I am definitely your girl to be able to help you get that lined out and see if you can qualify on one of these programs. So reach out to me. I'll help you on this DSCR program.
Thanks so much for listening. I really appreciate it. So stay tuned. We are going to learn some more next time.